Hey everybody, welcome back. Mynor Ramos here, and I am joined by Michael Domico. And today we're going to be talking about one of these principles that we cover in advanced insurance principles that we're going to be doing a series of videos on. This one is really interesting. As a mortgage banker, I had to learn the concepts of there are so many banking strategies, and we're going to go into and Mike, if you want to take a few minutes and explain the concept of infinite banking, because there's a lot of talk about it out there, but I don't know if everybody is really getting with somebody with your experience, over 40 years in the industry, and you saw, earlier somebody saw the video of your introduction to the business, but here we are, we're sitting with a legend talking about infinite banking. So please take it away.
A legend. Well, that's scary. Uh, as long as I'm not a memory, I'll accept legend. Well, Minor, thank you. I certainly appreciate the time to be with you and also the opportunity to talk to your audience. So I'll get right into it. Infinite banking is so simple a concept, and everybody stumbles over it. So let me keep it simple. I was always told KISS was the answer. Keep it simple, stupid. And I certainly fit right in. Infinite banking simply means taking a life insurance contract that has cash value. It's been done with both whole life and with universal life, and now IUL, to build a cash fund, but not a stagnant cash fund, not a cash fund that just accumulates and is given to a beneficiary someday, but a cash fund that the actual person who's insured gets to use. So what would be a practical application? Well, I was originally taught that infinite banking was a way to buy a car. And how it was discussed and explained to me was very simply, rather than going down to XYZ Bank and paying whatever rate of interest was currently being charged, borrow the money from your life insurance policy. You'll find that there are charges involved, but they're minor, no pun intended. And you control it. So instead of going in and asking some banker for some money, may I have some more porridge, please? You actually sit down with yourself and you say, I think it's time to buy a new car. And you list all the reasons and you buy yourself a new car and you borrow the money from your insurance plan. Now, there's a couple prerequisites that you want to keep in mind. Number one, you're talking about an insurance policy that, first of all, normally has more premium dollars added to it than what you would normally think of for life insurance. And people will say, well, why do I want to do that? Well, specifically, you want to do it to leave yourself in the position of being able to have an infinite banking program. So, whereas some people will put money in life insurance and then save money to buy a car, you put more money in life insurance, borrow it out, and buy your car. So the first prerequisite is you're talking about usually a larger premium dollar than an average person might consider appropriate. The second prerequisite that you want to do is you want to use the same diligence paying yourself back as you would the bank. Because if you don't pay the bank back every 30 days, you're going to get a notice saying, hey, you owe us. So you want to be diligent enough to pay yourself back for two reasons. Number one, it doesn't harm your insurance policy because you're paying it back. Number two, as you'll see, you can help accelerate the increase in cash in your life policy. And how do we do that? And that's the third principle. Pay yourself interest. If you went to the bank and they're charging you 5, 6, 7, or 25% interest, whatever the rate is that day, you have no choice. You pay that back. So if you want to be real nice to yourself and say, well, instead of paying the 8.5% that the bank is charging, I'm going to pay myself 5%. Do it every month. Make that payment. Not only will you maximize and multiply your cash value, but when that first car is reaching the end of its life expectancy, you can sit down with your banker, which is yourself, and say, you know what? I want to get a new car. Or maybe you just want to get it for fun. I don't care. It doesn't matter. It's your money. You go back to your insurance policy, you borrow the same money out the same way you did before. You have the same tough paperwork to fill out to get your money, which is you call your insurance agent and order the money, and you diligently pay it back and you pay yourself interest. If you do that, statistically, every third or fourth car will be 100% free. This is the power of infinite banking. That's only one aspect.
It's only one aspect. Yeah, because we in future videos and in the webinar, we're going to go into some of the other aspects that, that comprise and where you can house it. I like to think of redirecting that, those funds and thinking like a banker. I will say for our audience, we're probably have two types of people listening to us. We have that insurance agent who's maybe has been in the captive world, has gone to some kind of, large, captive type environment, and they're looking to grow. Maybe a professional in the independent world is just looking for, some more strategies. That's why, we talk about strategies. But we also have a lot of people who I describe as there are three different levels of finance thinking. That level one thinker is, that there's somebody here in Tennessee, just on the other side, big guru, everybody listens to him. And what does he say? He says, you can't, you got to get out of debt. You got to get out of debt, and doesn't really like this type of insurance product. Listen, for some people in that level of finance, I kind of agree. These are the people that are living paycheck to paycheck and don't understand that you should only buy things with profits, not with net money, right? The second level is that type of person, is the people that understands that your money needs to have babies. Let's just call it that. Call it that. And then the third one is really, now we're talking into some of these, these ideas that we're gonna talk a little bit about the next topic in the next video, where now you're talking about arbitrage. I mean, now this is kind of cool. But I will say, word of caution to everyone, you cannot really enter into this until you know the four major numbers. And that is, you have to have a solid cash flow, information. So number one, that would be all of your expense, all of your income, all the household income, all of the expenses, all of the debt, and then that creates the working cash flow. No more talking about budgets, working cash flow. And then we're going to be able to go into and figure out the strategy.
Mynor, can I introduce a visual here?
Absolutely.
How I originally learned financial planning and estate planning was referred to as the ice cream cone method, which is just a visual of what you just said. So if you look at it visually at an ice cream cone, you take care of all your basic expenses. That's the first cone. After your insurances are done, your mortgage is covered, all your basic expenses, the discretionary income is the money that starts to overflow out of that cone. It goes into the second cone, which then gets into savings programs and how you budget your money and how you plan for education. And I just throw that out to the public as a visual so that you don't try to save for retirement before you've handled your mortgage. That's where you get into trouble. And that's where the gentleman that you referred to is good at, because he tells you got to get rid of those debts. So I don't disagree with him, but having the visual and understanding that by following some basic steps, you can get to where you want. You just don't want to get there before you're ready to get there.
There it is. There it is. All right. Well, hey, listen, we have a lot to cover. Future videos coming up. Mike, thank you very much for that wonderful just illustration, to help people just kind of, let it cement in their head. Until next time, come back and watch us again for the next video. Thanks, guys.
Thank you.